Hi everybody. So today we're going to be working on understanding how to do adjusting entries, and the resources that we're going to use are Kimmel Weygandt Kieso's Financial and Managerial Accounting textbook. In this we're looking at chapter number 3. So real quick, just make sure that you like and subscribe so that you can stay posted with our accounting and finance updates, and comment below if there's any additional resources that you need help working through. So the question here says, so this is problem 3-1B, and it says Lynda Rigg started her own consulting firm, Vektek Consulting, incorporated on May 1st, 2014. The trial balance at May 31st is as follows. So they've given us a basic trial balance to start off with, and remember that this is that point in time where the first stage of the accounting cycle is already done. You've done your journal entries, you've done your ledgers, and you've created your trial balance. And now you're going to go back and look at all the adjustments across that time period. So then they go on to saying that in addition to those accounts listed on the trial balance, the chart of accounts for Vektek Consulting also contains the following accounts and account numbers. As we work through this problem, we're not going to work with the account numbers because that's a part of the automation of any accounting software or system. We're just going to be looking at how to do the journal entries with those specific account titles. So you can see account titles like accumulated depreciation equipment, salaries and wages payable, supplies expense, depreciation expense, insurance expense, and utilities expense. And these are all of the accounts that we're going to use in addition to the trial balance accounts. In other data, we are basically looking at 7 adjusting entries over here. And so for these 7 adjusting entries, we're going to analyze the data. And in the instructions, you'll see over here that the first instruction is to prepare adjusting entries for the month of May. So in this, the first entry that we have is $500 of supplies have been used during the month. So if we keep in mind that each adjusting entry is directly associated with something that's already happened on the trial balance. When we say that $500 of supplies have been used during the month, that means that that account should ideally decrease by that amount. And if you look at the trial balance, your supplies balance states $1,500 in debit, and from this $500 of supplies have been used. And so the basics of adjusting basically say that when an asset decreases, it needs to be credited, and against that, the utility is to be identified as an expense. So your adjusting entry here is going to be supplies expense to supplies. So supplies expense is to be debited by $500, and supplies, your asset, is going to decrease and be credited by $500. For your second entry, it says utilities expense incurred but not paid on May 31st, 2014 of $200. So once again, you've got an expense, but against that, you're going to have a payable. So you've got a utilities expense to an accounts payable. And we're just going to confirm over here if we have a utilities payable. We do not. So we're just going to put it against our accounts payable, which is our short-term liability. And the expense incurred was of $200, so $200 to be debited and $200 to be credited. For our third entry, it says the insurance policy is for 2 years. Now, whenever insurance is utilized, again, it is to identify an expense against the use of an asset. So the accounts that we're going to use will be insurance expense to prepaid insurance. Now, the calculation that we have to do over here, and I'm just going to do this a little roughly, is because the insurance policy is for 2 years, and we say that the prepaid insurance is for $2,400. So essentially, we're saying that the $2,400 is to be divided by 24 months. And we know that we have to use 24 months because when we saw the question indicated the start of the company on May 1st, and this trial balance is on May 31st. So we're only looking at 1 month of adjustments. So to ensure that we only account for 1 month of adjustments, we are going to put in $100 in our insurance expense and our prepaid insurance. So $100 to be debited and $100 to be credited there. For our fourth entry, we have over here. So our fourth entry is going to be $1,000 of the balance in the unearned service revenue account remains unearned at the end of the month. So this basically means that we did all of the other work against our service liability except for $1,000 worth of balance. So if we look at the account on our trial balance, unearned service revenue has a balance of $2,600. And from this, we're decreasing our liability and we are increasing our revenue earned. So decrease of liability means that our unearned service revenue is going to be debited by $1,600 because we've completed that much work, and our service revenue account, that is the recording of revenue, service revenue account, is going to be credited by $1,600. So a quick look at the mathematics of that. $2,600 minus $1,600 will leave us with the balance of $1,000, and that is how serial number 4 or transaction number 4 is to be adjusted. For number 5, we have May 31st is a Wednesday and employees are paid on Fridays. So if May 31st is a Wednesday, that means we're accounting for 3 days worth of work. Vektek Consulting has 2 employees who are paid $500 each for a 5-day work week. So real quick, whenever we look at salaries and wages, the entry or the adjustment that we're looking at will always be an expense to a payable. So salaries and wages expense credited to salaries and wages payable. Okay, and how do we do the calculation there? So the calculation there is going to be the number of employees that you have. In this case, because both of your employees are being paid the same amount of work, we will take your weekly wages, so $500. We will divide that by the number of days that you get paid that much money for, and then we will multiply that by the number of employees that we have at this particular wage. So we pay our employees $500 for a 5-day work week. So we take 500 divided by 5, and we have 2 employees that are paid in this way, which means that our daily wage for both of our employees together is going to be $200. And in this particular case, we also want to multiply that by the number of days that we're accounting for. So Monday, Tuesday, Wednesday means it's 3 days worth of work that they have done. So that is $600 in adjustments. So we'll debit $600 and we will credit $600. For entry number 6, we have the office equipment has a 5-year life with no salvage value. It is being depreciated at $200 per month for 60 months. So because they've given us the amount, we're just going to go ahead and utilize that ease. We know that depreciation is always to be adjusted as depreciation expense to be debited to and accumulated depreciation for whichever asset category. So accumulated depreciation, in this case, this is for equipment. Accumulated depreciation equipment is to be credited. Now, because they've given us the value, we're just going to enter it. It says $200 per month. We know that we're adjusting for 1 month. But real quick, if we understand the calculation, it'll give clarity for future adjustments. If we look at the value of our asset, equipment is worth $12,000. Now, they don't mention any salvage value over here, so we just want to take the book value of the asset and we want to divide it by its useful life. And again, useful life is to be translated in terms of the time frame that we're looking at, because we're looking at it on a single month basis. So we'll divide by useful life as translated in terms of months. So 5 years in months is basically 60 months. So 12,000 divided by 60 gives you $200 worth of adjustment in any given month. And that is how they give us that particular value. But just for future reference, in case they don't give you the value of depreciation for any time frame, whether it's a month, a quarter, or a year, you will always remember how to calculate it based on this formula. Moving on to our 7th entry. So the 7th entry says, invoices representing $1,400 of services performed during the month have not been recorded as of May 31st. Now, whenever you provide a service, but you've not yet recorded it, that basically means that it's not been paid for either. Okay, when you generate an invoice, it's because a client is not paid for that service. So we want to remember that when our client owes us money, we put that into an accounts receivable. That is the development of an asset for us. And this will go against a service revenue. So that's our revenue generating account. So accounts receivable to be debited by $1,400 and service revenue to be credited by $1,400. And so this is part A or instruction A for question number 3-1B. So let's move forward to part B, and I'm going to do this on the same Excel sheet so that this is also available for reference later. What we want to do is we want to create ledgers for all of these accounts, and the way that we create a ledger is we have this sort of 4-column layout where we'll have a serial number to tally all of the entries with. Then we'll have a debit column, a credit column, and then we'll have a balance column. Now the key here is to ensure that you're using it for the right account at all times, right? The debits and the credits will all function according to whatever account we have created. Now you'll see that I left a lot of space on the first one, but I'm not leaving as much space on the remaining ones. That's basically because most of your accounts will only need a couple of entries, maybe 2-3 entries at most. And because a ledger has a rolling balance, we don't have to worry about calculating at the very end of that. Okay. So now what we've done is we've created a whole bunch of ledgers over here, and we're just going to put in entries according to a specific account. So our cash has an opening balance of 7,700, and you'll see what we're doing is we're copying off of our original trial balance over here. Okay, so we've got cash, then we've got our accounts receivable, and so we're creating a different ledger for each account because this is our opening balance. I'm just going to put that in for $4,000. Then we have our supplies, and this has a balance of $1,500, and we're just going to go on, keep making this list. Okay, you can just keep seeing how we do this. It's just picking up every number off of our original trial balance and putting it into the ledgers over here. Now, the good thing with this is once you are done creating all of the ledgers, then you just have to update them for all of the entries that you have. Now, you'll notice that whether it's an asset account or a liability account, I am not changing the position of the balance. That's because it's not a T account, it's a ledger. So in this case, it is our knowledge that will contribute to understanding which side is to be entered on the debit side, and which account is to be entered on the debit side, which account is to be entered on the credit side when we create our final balance, okay? When we create our final trial balance, essentially. So after unearned service revenue, then we have our common stock, and that is $16,000. After common stock, we have our service revenue, and service revenue has $8,500 in balance. And then we have salaries and wages expense. So salaries and wages expense has a $3,000 balance. And lastly, we've got our rent expense. So rent expense has $1,000 in balance. Okay, so basically we've already translated our trial balance into our ledger, our opening balances on our ledger. Now we're going to go back through each one of our entries over here, and we're going to transfer this onto our ledger. Okay, so the first one, supplies expense to supplies. And if we look over here, we don't have any supplies expense account. So I'm just going to go ahead and put in a supplies expense account. And over here, my serial number is going to be 1 because it's the first transaction that I'm looking at. So supplies expense is to be debited by 500. And that means that my balance in this account, because the expense account's normal balance is a debit side balance, that means that it's increasing the balance over here. So we started with 0, and now we have a debit of 500, so our balance is also going to be $500. So our supplies expense, the first part of our entry, is done, and now we have to do supplies to be credited by 500. And we already know that we have a supplies account over here, but our first serial number is a credit of 500, so $1,500 minus 500. The credit side decreases the asset balance, so we are left with $1,000 in the balance over here, and you'll see we keep calculating the rolling balance. So the first serial number is done. Let's do the second. Utilities expense to accounts payable. Again, we don't have a utilities expense already listed here, so we'll create a new account and we will say utilities expense, and this is our second serial number, and utilities expense is to be debited, and specifically debited by $200. And again, expense debits are an increase in the balance, so balance of 200. And what this will do is it'll increase our accounts payable. So our second serial number is to credit also by 200, and that means the credit is increasing our liability. So our balance will now be $4,700. That's $4,500 plus $200 gives us $4,700. Then for number 3, insurance expense, debit to prepaid insurance, credit for $100. Again, we don't have an insurance expense account over here, so we're going to go ahead and create one. So insurance expense, and this is for serial number 3. This is debited by $100. Expense means that the debit side is increasing our balance, so our balance will become 100. And this will go to prepaid insurance, which is up here. And this is our third serial entry, and it is to be credited by $100. And so the credit side decreases our asset account for prepaid insurance. So $2,400 minus 100 will give us $2,300 there. This is our third entry. For number 4, we have unearned service revenue to service revenue, $1,600. And if you see, we've got both of these accounts created, so we'll just put in number 4 over here, debit by $1,600, and that means that your liability is decreasing. So $2,600 minus $1,600 leaves you with $1,000. And just a real quick reference there, if you go back to the transaction number 4, it says $1,000 of the balance in the unearned service revenue account remains unearned. So when you do the mathematics for the balance over here, it gives you the exact statement, so you know that you're on the right track. So once again, number 4 says unearned service revenue debit by $1,600 and service revenue to be credited by $1,600, and this is entry number 4. So credit that by $1,600. So $8,500 plus $1,600 will give us $10,600. Sorry, $10,100. There we go. $10,100 is the sum of the balance in our service revenue. The next entry, number 5, says salaries and wages expense debit $600 to salaries and wages payable $600. And if we look at our accounts here, we do have a salaries and wages expense, but we don't have any salaries and wages payable. So we're going to go ahead and put in the balance. So $500 there to be debited by fifth entry is to be debited by $600 in the wages expense. The expense, whenever debited, is an increase in the balance, so that gives us $3,600 in the balance. And I will create a new account over here. So salaries and wages payable, that's a new liability account that we're creating. This is entry number 5. It is to be credited by $600, and any liability that is being credited is increasing in balance, so $600 in our balance there. And then number 6 says depreciation expense debited by $200, accumulated depreciation credited by $200. So if we come over here, we don't have any depreciation expense previously noted. So we're just going to go ahead and create a new account over here. So depreciation expense is our new account, and this for entry number 6 is to be debited by $200. And any expense that is being debited is an increase in the balance, so the balance becomes $200. And we also don't have any accumulated depreciation accounts. We're going to go ahead and create a brand new accumulated depreciation equipment account. Remember, all assets are their accumulated depreciation is identified separately. So for serial number 6, our credit is by $200. The accumulated depreciation account is a contra asset account whereby a credit is an increase in the balance, so the balance becomes $200 over here. And now for our last entry, we have an accounts receivable for $1,400 debit and service revenue $1,400 credit. So we're going to go ahead and put that over here. Accounts receivable already exists on this list. It should be right there. So entry number 7, and this is for $1,400 debit. And remember, a receivable is an asset account, so 1,400 is an increase in that asset account. That means we've got a balance of 5,400 here, and that accounts receivable is then going against our service revenue over here. So entry number 7, this goes into $1,400 credit, and the revenue being credited is also an increase in our balance, so that's 11,500. That is what we get, and that's our final balance. All 7 adjusting entries have been transferred into our ledger, and now what we want to do is we want to make a trial balance. So just for my own ease, because I don't no, in fact, here we go. For my own ease, I like to always create my trial balance on a new account, on a new Excel sheet, because it helps me retain the information that I've already worked with. So we're going to create an account title, a debit, and a credit. And remember, it's our knowledge of the normal balances on these accounts that'll help us determine which account is to be debited and which account is to be credited. So if we look at our ledger over here, we're starting off with cash. Now, we didn't touch cash in any of the adjusting entries, so cash is going to give us a balance of $7,700. So remember, cash is an asset account, and its normal balance is in the debit side. So cash, $7,700. We've already done this. I always like to bold my account on my Excel sheet after I have entered it. That reminds me that I've already put it in the trial balance, and I won't double up any of my accounts. Then we go into our accounts receivable. So accounts receivable for a balance of $5,400. And here we go. We're going to put in accounts receivable for a balance of $5,400, another asset account with a normal balance on the debit side. And again, I like to bold that right there. Okay. Then we've got our equipment for a balance of $12,000. And we put in our equipment for a balance of $12,000. And then we have our prepaid insurance for a balance of $2,300. So prepaid insurance for a balance of $2,300. Okay, going back, here we go. Let's go ahead and bold the 2 that we've just done. Okay, then we have our accounts payable for a balance of $4,700. Now be careful over there, because the accounts payable is a liability, so the $4,700 is going on our credit side. Okay, and against that, our unearned service revenue, also a liability, for $1,000. So unearned service revenue for $1,000. There we go. Okay, common stock is an equity account for a balance of $1,600. There we go. 16,000. My bad, forgot a 0 in there. And service revenue for a balance of $11,500. So $11,500. Then we have our salaries and wages expense for $3,600. And remember, salaries and wages expense is in expense account, so we want our balance to show up, normal balance to show up on the debit side. And rent expense for $1,000 here. Okay, $1,000 there. Okay, once again, real quick, I'm just going to go ahead and bold out the ones that I've already transferred into my trial balance, so nothing doubles up. And moving forward, so supplies expense for $500. And then we have our utilities expense for $200. And then we have our insurance expense for $100. And then we have our depreciation expense for $200. And salaries and wages payable, real quick, remember that that is a liability. So I forgot to check the balance there. Balance for $600. So salaries and wages payable for $600. Liability counts balance comes on the credit side. Accumulated depreciation equipment for a balance of $200. There's a contra asset account, and that'll come on the credit side there. It behaves the opposite of a traditional asset account. And those are all of our accounts. So we're going to go ahead and bold those real quick. And just remember that we've already put them into our trial balance. And we are done with this particular part. Now, remember, the key to a trial balance is to ensure that both sides equal at all times. So we're just going to go ahead and take the sum of our debit side, and we're going to compare that to the sum on our credit side, and fingers crossed they're both going to turn out exactly the same. Oh no. Just a moment, so we've forgotten something. Okay. Unearned service revenue. We have forgotten some entry along the way. Supplies, right there. So we can see it's not bolded there. Supplies for $1,000. Let's take a quick look over here, and that's right. So supplies have not been entered into our balance, into our trial balance. This is where actually making those accounts bold really helps out. So here is our supplies, both sides of the account balance, and there's always a few hints along the way within the book, and you'll see over here. So part C shows that the adjusted trial balance at the end of the day is going to have a trial balance of $34,000. That's exactly what we got, and so you know that the question is spot on correct. Once again, thank you for watching, and let me know if you have any questions in the comments below. Don't forget to like and subscribe, and let us know if you need help with any other resources in accounting and finance. Thank you. We'll be back with more questions.